CCP performance has been, to begin with, very broad-based, right? So the chart on the left, the exhibit on the left, shows you the 13 stocks in our CCP portfolio, how their year-to-date till today, till 11th of March, how the YTD FY20 share price movement has been, and how over the last 3 years and 5 years, the share price movements have been. What is in particular worth noticing here is the spread, as in it's not driven by one or two stocks. It's actually pretty broad-based for these stocks over the last 1 year, 3 year, 5 years time period. And more importantly, what you can see is on the chart on right, the fundamentals of these stocks have fully supported, actually more than supported, the increase in their share prices, right? So if you compare the chart on the right as earnings growth versus the chart on the left as valuations, as long as earnings growth is not lagging behind valuations substantially, there is no concern at all. In fact, in some cases, for instance, if you look at the financial year 2020, so the third column in the chart on the right, which is FY20 earnings, right? The earnings have gone up by around 31% based on the 9-month performance. That 31% earnings growth compares with 25% overall portfolio performance, right? So just to make the point again very clearly, as long as the 25% portfolio performance is backed by 30% sort of an earnings growth, we've actually become cheaper on PE multiples against the optical illusion, I would call it, that if the portfolio has delivered 25% in such a difficult time, then we might actually have become more expensive, right? So that's the performance in front of you. Over the last 5 years as well, the gap between our portfolio's earnings growth and Nifty 50's earnings growth is the same as the gap between our portfolio's share price growth versus Nifty 50's share price growth, right? Which again suggests that our outperformance relative to the broader benchmark is supported by fundamentals fully, in terms of outperformance of the fundamentals versus the rest of the economy. And this is quite important to also digest, because over the last 5 years, India's economy has gone through a very turbulent time. It's been a very benign environment in terms of economic growth out there. And hence, with a 3% Nifty CAGR in earnings, the portfolio has instead delivered a 20% earnings CAGR, right? So that's the broad conclusion. The summary has come up now. Now, why has this happened? And one of you has already asked us this question in this webinar already. I can see that why, if the economy doesn't grow, why do we expect our portfolio companies to keep growing their earnings? Now, this in particular has happened. The third bullet at the bottom, which you can see, is in particular because of accelerated market share gains. And ability to gain market share for great companies actually increases during difficult times, because when it's euphoria all around, it's very difficult to beat your competitors, right? So to put it very simply, for an HDFC bank to beat a Yes Bank 3 years ago would have been a lot more difficult than what it would be today, right? That's quite an obvious way to look at it. Acceleration in market share gains, I was making a point, is the main reason why earnings growth is resilient despite a difficult economic environment. As long as that resilience of earnings growth sustains, the share price growth will also remain resilient, right? Now, the last bullet on this slide mentions about how the recent regulatory changes, especially things like corporate tax rate cut, GST, before that demonetization, etc. All these changes are creating a massive snowball effect, where the small and weak companies in every sector are becoming weaker and smaller, and the good and great companies
in every sector are getting a very big opportunity to consolidate, right? So the firepower available to our portfolio companies after the corporate tax rate cut is going to be redeployed onto the balance sheet to grow their capital employed in various areas, which will incrementally help them to gain more and more market share. Right? This could be by giving extra incentive to your employees in order to reduce the attrition rate. It could be accelerated capex. It could be cut down in product prices to suffocate competition where the competition doesn't have the benefit of lower corporate tax rates, etc. Right? Various sorts.